Welcome to the Jill on Money Show. It is Super Bowl Sunday, February 13th. And since CBS doesn't have the Super Bowl this weekend, I am going to do what is essentially like the investor Super Bowl. We're going to run the second part of our interview with Spencer Jakab. He's an editor at the Wall Street Journal. He's also the author of the new book, The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. You know, it was just about a year ago when we had all the money that was going into professional sports pouring into meme stocks. See the connection here? Super Bowl, betting, and now betting on these little stocks that were seemingly going out of business. Well, I think that this is a great way to remind yourselves why betting on sports may be actually much more fun than betting on stocks. That's what I think, because you usually are using the sports betting as just like a fun thing, not out of control. I'm just going to lose a little bit of money. I don't care. Somehow or other, with stocks, we let it get away from us. And I think that this is something of a real misconstrued story when we talk about the GameStop and the AMC. And, you know, as far as I'm concerned, the idea of what many of the investors in this movement were trying to do, which is really, you know, kind of stick it to the entrenched interests of Wall Street, it failed. So, you know what? It is time for us to really understand what it is that happened a year ago. Didn't really get back at the man. All it did was make the man a lot richer. Here's the second part of our interview with Spencer Jakab. What you point out at the end of the book, which is horrifying, and I'm sure that no one wants to believe this, is like, bully for you guys. You just made every single firm that relies on trading and investing a lot richer in 2020 and 2021.
Well, that's the crazy thing, right? And that's why the title is The Revolution That Wasn't. I mean, it would be a great story anyway if you just told the story. But you have to point out these people, and they don't like to hear it, because the people will say, well, I made a lot of money, or I'm still holding, or whatever. Good for you. Of course, any kind of bubble, and this bubble hasn't completely deflated, people will make money. But who made the most money? Like Wall Street, that's what you have to understand. Wall Street is a big place, and most people on Wall Street are middlemen. And the money is really made during times when people are active, when people are excited, when people are convinced somehow that they can beat the house. An analogy that I use in the book is you go to Las Vegas, and 100 feet away, all of a sudden lights and sirens go off, and somebody won a gigantic jackpot from the casino, like so big that like the casino won't make money that day. You know, they had to pay them a lot of money. You know, do you think the casino's sad? Do you think that it's an accident that they point, you know, spotlights at the person, or like when someone wins the Powerball that you pose with a huge check in front of your house? Like, no. They like that. That excites other people. They think, oh, it could be me. I'm gonna play more. This is exciting. This is fun, right? And the casino lost money that day, but it's good for their business in the long run to have people crowing about their success and having obvious financial success, because people are pumping quarters into the machines faster. And not just that, but the hotel and the cab driver and the bartender and everybody else who doesn't take a risk, who isn't going to have to pay out a jackpot, when more people are showing up and they're making them rich. And a lot of the companies on Wall Street are like that cab driver. They're just glad you showed up.
And it's so funny because they are also taking advantage of the fact that they have been so profitable. And you mentioned that Morgan Stanley bought E-Trade. Happily, like glowing and saying like, yeah, these morons keep trading and we're making money. And one of your colleagues, Justin Baer, just had this great headline, which cracked me. I literally started laughing when I saw it, and I still get the physical paper. So apologies to the environment. But I saw the picture of Abby Johnson from Fidelity, and the headline was, Fidelity, once stodgy and adrift, bets on the Reddit crowd. If you don't see the confluence of like how establishment is using you in that headline, man, I don't know where it is.
I have my 401k, and I'm not allowed to own stocks, but I just have funds and stuff like that. But I got an email from Fidelity last week because, you know, I have kids. I have a 15-year-old as my youngest, and It's like, open up a youth account where you're a 15-year-old. Like, what?
I got a call from the Fidelity PR people because I said when they opened those youth accounts, I'm like, this is redonkulous. I cannot believe they're doing this. But whatever, they're cashing in, right?
Yeah. I mean, money, it's capitalism, right? And Robinhood, they made this beautiful app, but I spoke with problem gambling experts who look at the design of gambling apps. And first of all, what they tell you is that, that the only type of gambling that skews very young, where it's sort of the amount of money lost and spent is inversely correlated with age, is sports betting. And sports betting had taken off in 2018 after it was, a big Supreme Court decision allowed it to be legal in many states, most states. And these young people, young men, and I have young men in that age cohort too, who are old enough to sports bet. They don't do it, but almost all their friends do it. About 75% of their friends do it. And all of a sudden, there are no sports. So that created an opening. And these apps are designed in the trading apps like Webull and eToro and Robinhood in a way that is eerily similar to these gambling apps in terms of, Robinhood finally took away this feature after they were sued, but like confetti going off occasionally and stuff like that, which is based on psychological principles that are of intermittent reward, where if you won every time, it would be less exciting than winning randomly and getting rewards, even if it's just, confetti on a screen randomly. And to these people, so I'm not saying it, they're saying it, don't sue me, Robinhood, but it is almost definitely taken from the design of gambling apps that try to reinforce the same psychological trends and push the same buttons.
I mean, anyone who's walked through a casino and hears a gling, 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 and knows that there's no windows and that you create this sort of ecosystem and you understand it. And of course, it's, they have neuroscientists designing these things, right? And,
yes, they do,
same, right? So it's not surprising. What's the big takeaway here, besides the fact you didn't stick it to the man? I mean, we have a lot of people who listen who want to trade a little bit in stocks. Maybe we have some parents listening who are worried about their kids. What's the messaging here? What can we have them take away?
Well, I think three things. One is it's exciting to trade stocks. It's a great intellectual exercise. The stock market is there. It's this game. Points are money. I get it. But if you or a young person in your life, wants to show their stuff, my advice is to sequester some small part of your money that if you lost it all, you would be okay. And only play the game with that part of your money. And the reason I say that is that the same technology, this is my second point, the same technology that made this possible, all the competition and technology that made Robinhood possible and made $0 commissions possible, and Robinhood says it democratized finance. Finance was already democratized because you used to have to pay a fortune to get into the stock market. To make a trade. They wouldn't even take your money if you had, $50. They wouldn't open an account for you. And today you can open an account with so little money and get charged so little just to buy a bunch of index funds, which is what I own personally. And you just buy them and set it and forget it. And the third point is that by doing that, you're accomplishing exactly what these people wanted to accomplish. So if you're a young person and you want to stick it to the man and make money, if you just take the bulk of your money and you're pretty passive with it, you don't check it a lot, you don't panic when the Dow's down 1,000 points, you just set it and forget it, contribute and let it compound, you're going to beat, I'm sure, 80 to 85% of your peers and 80% of fund managers, by the way, too, by just doing that. And you're going to pay Wall Street peanuts, nothing, a little bit, but almost nothing. Wall Street hates that, and they hate it when people wise up. So you want to stick it to the man, there's your answer. You just do this boring stuff. And if you just can't tear yourself away, then just do it with some small part of your money. Maybe you'll do well, but don't gamble, the bulk of your money in this. And remember that when you deal with Wall Street in any capacity, when you deal with anybody really in any capacity, there are people who get paid on the front end and people who get paid on the back end. Robinhood and its ilk get paid on the front end. They don't care what happens later. Deal with people who are trustworthy and fiduciaries and who care what happens on the back end. They're much better people to deal with generally with your money.
Well, thanks so much to Spencer Jakab for joining us, and we thank you for joining us. If you've got a financial question, just go to JillOnMoney.com, click on the Contact Us button, and we'll get your information and your question. Don't forget to let us know if you want to come on the air. We'd love to have you. Try to lift someone up today. Grit, growth, grace. Good luck to your team. Have fun at your Super Bowl party, and we'll talk to you tomorrow. Thanks for listening.